the European contagion, if you like. The US was closed, but certainly Asia feeling the impact. Now, how do you, for your clients, digest all of this, Todd? I mean, do you say, don't worry about it because China's more or less insulated?
Well, we've seen this before. We saw this in 2008, and China and Asia had a very steep slowdown at that time. There's a couple differences. One is that the PBOC tightened rates just 12 months prior to the whole global crisis that we had in 2008, and they had to jack up and spend a lot of fiscal firepower, and it created 30% plus credit growth and a quasi-bubble in the property market there. So this is the reason why we think the next move from the PBOC, and this is quite, I think, a contrarian view, that they're going to start easing in the next month or two.
That is definitely contrarian, because for the month of August, for the first time in a year, they haven't actually raised interest rates or the reserve ratio requirement.
True. And last print we had on CPI for July was 6.5%. SocGen Economics is calling for a 6.2 to be announced this Friday, and that would be the biggest CPI slowdown that we've seen this cycle, from 6.5 to 6.2. Now, it's not at the 5% target they're looking for, but look at the world. We're not accelerating here, we're decelerating. I think inflation is just getting moved right off the table. We've been tightening for 18 months in Asia, and the equity markets are pricing in double negatives right now. And this drives me crazy at this point in the market, because you're not going to get tightening and a slowdown. So either take one or the other. But I think we're slowing down. We're going to get a lot of earnings cuts, but then we're going to start getting a lot of interest rate cuts across Asia. And that's going to at least ease some of the pressure of the global slowdown on the domestic economies.
Interesting that you compare it to 2008, because overnight we had Joseph Ackermann of Deutsche Bank saying that, in fact, this reminds him of 2008, obviously referring to the Lehman collapse, the tightening of credit, etc., what happened, the freezing of credit, if you like.
Yes.
And you're saying it's like that, but for China it's very different. So therefore, do you think that this is a good opportunity to buy into the lows because valuations are quite strong?
Yes, I think the valuations are ridiculously low in China. And also Korea, and also I think India, relative to the return on capital in that market. I think there's some very, very cheap markets in Asia right now. Obviously, we're in free fall right now, so you got to pick your entry. As you mentioned, the euro basis risk amongst banks is getting wider, so we're getting into crisis territory. But we're also getting to a point where we're getting the policy response. You know, Bernanke and Obama are going to come out with announcements on Thursday. Now, it's not going to be the panacea. It's not going to be, okay, everything's going to be fine. But you are going to get announcements. You're going to get quantitative easing. You're going to get Operation Twist. You're going to end up with Obama announcing a new jobs package. All these things are going to be, kicking the can down the road towards trying to find a solution. And meanwhile, you've got valuations in Asia at near 1980s lows. The global equities are now getting close to 85, 83 range, and that's cheap.
Is it a brave investor, therefore, to go into these low valuations? And which areas would you go into? I see you mentioned the Chinese banks.
Chinese banks is one area that we now find more value in. There's problems there. I mean, obviously the local government debt problem is probably going to get pushed off till 2013 because of the political change that's going to take place in China in the second half of next year. But some of the NPLs are already starting to build up. But we see some value in there. We see some value in the insurance. The industrials are completely bombed out, and there's some very cheap stocks. But let's keep this in mind. I mean, yes, the world is slowing down. We're pricing in recession. There's going to be relative winners and losers. And I think when you get quantitative ease, a lot of capital moves into emerging markets. Emerging markets had $65 billion of capital move into them over QE2. We're probably going to get more this time around. And so that means strengthening currencies, too much money in the money markets. At the same time, a lot of that money finds its way into equities as well. So, we're not going to go down forever. And I think on a relative basis, emerging markets, and in particular, very cheap Asian markets like Korea, Hong Kong, China, and India do extremely well.